afternoon and welcome to the final session in the FOW European Derivatives Conference. I'm happy to welcome Bob Ryan, Chief Strategist of Commodity and Energy Research at BCA Research, to this session as moderator. Accompanying Bob, we have guests from Vattenfall, Sucden Financial and B3. Today, we are looking at the environmental, energy and metal commodity space and assessing how these markets will play out in the coming months. Don't forget to ask questions to our panelists using the Q&A function. Please also remember that these sessions are being recorded and will be available to view on demand. With that, I'd like to pass over to Bob.
Thank you, Philippa. Thank you all for joining us on this conference today. Before I start with our discussion, I would just like to offer a few opening remarks here. We're going to be looking at the commodity supercycle. It's a phrase that turns up very frequently of late, particularly regarding the industrial commodities, oil, iron ore, steel, copper, and of course the ags. Iron ore, steel, copper all hit record highs price-wise in recent weeks. Argentina's government is limiting beef exports. Grains have posted double-digit returns this year and already have hit multi-year highs. Brent briefly flirted with the $70 a barrel mark following pricing below $20 a barrel in the teeth of the COVID pandemic last year. Gold's rally has resumed and it's now trading or pushing toward $1,900 an ounce again. And all of this is occurring on the back of a GDP growth trajectory globally that likely expands as vaccine distribution increases. So central banks right now are on the watch. They're checking regularly with the real economy, which is the part of the world we all deal in, the folks on this panel. Looking for signs of inflation. They're fully expecting to see higher commodity prices, and for the moment are willing to view them as transitory. This is all occurring before we even talk about the global push toward renewables, the movement toward a low carbon future that includes not only the renewables but electric vehicles. All of which is going to require massive investment in base metals and carbon capture technology. So joining us on this panel today, Louis Gourbin from B3 Commodities, Frank Van Doorn from Vattenfall, and Geordie Wilkes from Sucden Financial. I would like to start with the ags and then move to metals and the future of energy commodities. As is going to be apparent, these commodities and their respective trading markets all very quickly converge on a couple of common themes, which we'll draw out here. In Europe, we've witnessed the rise and the fall of the appeal of biofuels to consumers, with food versus fuel debate now revving up again, no pun intended. The carbon footprint of electric cars also is being questioned. Louis, if you wouldn't mind, if you could address the impacts of this evolution for the ags and the energy commodities, I'll turn it over to you.
Louis, you're on mute.
I apologize. Thank you, Bob, for the introduction. Thank you, FOW, for the invitation for B3 to participate to the discussion. I'd just like to start just briefly introducing B3 and myself. B3 is the Brazilian exchange. It is the merger of BMF and Bovespa and CETIP. So BMF, the futures exchange, Bovespa, the equities exchange. CETIP, clearinghouse, OTC clearinghouse, that in 2017 merged to become B3, which is the Brazilian exchange listed and OTC. Of course, and myself particularly, I'm responsible for all the listed commodities products, right? So when we talk about commodities in Brazil and at B3 in particular, we mainly talk about agribusiness. And just to give a few big numbers here, I will actually just share my screen real quick, and I promise then I'll answer Bob's question. But let me just share my screen here, just to give an idea, because I think here it's less important to focus on the exact number as to give the scale of the importance of the subject in, again, the real economy. And I think throughout this discussion, we'll discuss what is the real economy and how does this translate into derivatives and other financial products. But I mean, if you look at the Brazilian photography, we're talking about 20% of the GDP. This is production and services. And 1 in every 3 workers, 43% of exports. Again, here are the main products in terms of production. The numbers in Brazilian reais are less important than the scale, again, because they can be dollarized, because there's crop-related issues, there are global prices, but just the scale, I think, is the takeaway here that I'd like to share with you. And if you look at Brazil as this kind of commodities powerhouse, it's in first or second place in production and exports with a significant share. So of course here it's in Portuguese, and I apologize because again, as an exchange, we don't make forecasts. I took public numbers from official sources, but I'm sure you can figure it out from the images. But again, grains is huge, animal protein is huge, and a relevant share in the commercial balance of the country. So this is the standpoint, from B3, and our role as a platform is to have to potentialize these players, through OTC and listed products, and trying to have an integrated approach to these products, from financing to the delivery, and trying to bring this discussion to the field. Because if you look at the Brazilian scenario, you come in a place where 40 years ago it was importing foodstuff, and now is the largest exporter. In a country where we've had double-digit growth and an exponential production of soybeans, corn, animal proteins. And so I think the focus has been for a long time the financing, but now we're moving towards really the risk management side, which is the core of this discussion. So without further ado, going back to the question here, I'm trying to stop sharing. Are you still seeing the screen? If one of my colleagues, panel, you're still seeing the screen or no? I'll share, there we go. I can't get back to my screen. I don't know if someone from the panel, Bob, can you hear me? Can you just tell me if I'm
Bob, you're on mute as well.
There we go. I've closed the PowerPoint. That way it seems to resolve the question. We're back. So in answer to your question, what is the impact of of this context for ags and energy? I think there is no simple answer here, and it would be maybe the theme for a larger debate. But I think can try to shed some light, asking some questions and pointing in some direction. I think the simple fact that it is a question is relevant. I think if you look at the energy commodities, on some level, the traditional, carbon ones are finite. The metal ones are finite. We don't necessarily know as a consumer, as an investor, when or how, but they are finite. Whether the ags is there's a cyclical reset, through crops and cycles and use of land and technology and yield. But I think, this apparent lack of consensus going forward, I think is going to be mitigated largely in part to local scenarios. I think that if you look at biofuels, it's a much different scenario. In Brazil, we have an excess of sugarcane and ethanol and arable land, whereas in Europe, where you're in industrialized countries with importing foodstuff, so local foodstuff obviously competing, in this food versus fuel debate. So I think technology will play a role, and I think it's going to be it's going to be interesting to find the balance in between who pushes this agenda. The consumer, okay, but what is the financial incentive to make this happen? Because ultimately, the certification, these guarantees have a cost, and who will bear the cost? And I think if you look at the Brazilian farmer, if you look at the trading companies, I think are kind of getting a bad press, which is not, in my opinion, representative of the hard work and efforts they put towards this. But it comes at a cost. So ultimately, who will say, no, this is important enough for me to invest $1 per ton, $5 per ton? And I think these are the drivers we have to watch out for, and how regulation may or may not, bump forward this agenda, and in which industry. And on this, I won't necessarily pronounce myself, but I think there will be a regional story.
That's excellent. Thank you, Louis. Also, you're talking about the finite versus near infinite ag potential. Just keep going into a new cycle. Frank, to what extent are your commodities related to and correlated to these, the ags, to just about everything? If you could first just briefly give us some background on your responsibilities and what markets you cover, and then give us an idea of how they're related and correlated to each other, and how they're affected by the evolution that Louis is describing.
Yeah, thank you, Bob. Yeah, I represent Vattenfall, which is a Swedish utility which predominantly produces power. And we're active in the Scandinavian countries, but also in Germany, the Netherlands, the UK. And apart from producing power, we also sell it, of course, to customers in the countries I mentioned, and also gas. And I am heading the trading unit, which trades power and gas physically around Europe, but also financially in Europe and other parts of the world. And besides power and gas, we also trade emission allowances, EUAs, financial coal, financial oil, biomass, and a bit of freight. So those are kind of my commodities, so to speak, with a really European angle. And they are all pretty related amongst themselves, or correlated, which is also kind of logical. If you have a gas-fired power station, then you produce, of course, power, and what goes into the power station is gas, and conceptually also EUAs, the allowance certificates, because that's what you need to produce the power. So they are heavily correlated, and together we kind of call them the energy complex, and it tends to move a bit together. Sometimes one is stronger, sometimes the other. And with regard to how they relate to the rest of the commodities, there's a strong correlation also with oil, clearly. So oil and equities in general, they are the main drivers for our energy complex. And I must admit, I never really looked at the correlation to X or to metals or anything like that. But getting a good handle on the commodities that I mentioned, that in itself is already difficult enough, I would say. Sure, yeah.
Sorry, I've got to take the mute off. I keep forgetting that. Yeah, the what do you call it? The super cycle that we're talking about. I know, Geordie, you're on a trading desk as well. Perhaps, and I think you actually do trade the metals. So maybe you could give us a background on what you're trading, what metals what markets you're involved in, and how they all sync up here.
Sure, of course. Thank you. So I work for Sucden Financial, and we are a Cat 1 tier member of the LME, and we cover metals, we cover FX, bit of fixed income as well. But my remit is research and to help with some of the trading strategy there. And what we've really seen, and especially in the last 14 months or so, is quite an extraordinary rise in metals prices. When you look at copper, for example, if you go from the March low in 2020 to the price this week, you're looking at 120% gain in prices, which is extraordinary when you look at the backdrop of the global economy and the transition we've seen in the last couple of months. And so really, the term supercycle, as you rightly say, has been spoken about a lot this year, especially in reference to base metals and industrial metals. I think in some senses, you're likely to see pockets of strong sustained growth for some metals, referencing to what you said before in terms of the green economy and electric vehicles. This is clearly a strong growth sector, but in other aspects of the metals, there's going to be less growth opportunity there, for example, for some of those metals, specifically around sort of ice engines and sort of maybe less acid batteries there. So really, it's yes, there is sort of a strong demand outlook for some of these metals, and as you rightly say, they are in finite supply, and we're sort of seeing lower grade ore quality as a general trend. But really, it's going to be sort of pockets of growth in some metals. And for example, one small metal, tin, has seen a large increase this year, and that's reverberated around other areas of growth, such as the auto sector, as the chips for those autos are sort of struggling to produce those chips, as following a significant rise in consumer electronics in the last year or so, as general trend moves away from experiences, because we've obviously been in lockdowns, into consumer electronics and goods like that. So you've seen pockets of that strong demand growth with supply struggling to keep up there, which has helped fuel the prices that we've seen so far this year.
Sorry. Yeah, the Green New Deal as well should increase some of that pressure. You're getting a lot of bond issuance and funding from the major economies now. It's not just a China story now. It's the EU that's making a lot of funding available. The US shortly will be, and then the banks. I think the banks have signed up for even more funding than has been allocated in that Biden infrastructure deal that they're trying to work through Congress. And almost immediately, the top banks in the US came out with trillions of dollars worth of credit. They said there is going to be available to fund this green initiative. As we talk about that, Frank, this green power, how does that fit into the complex that you're trading in and you're operating in?
Well, let me start with also kind of pointing out that allowances, carbon allowances that we trade, they have seen a remarkable rise in price. So we traded these EUAs, I think back in 18 for about 7 or 8 euros per ton, and now we're looking at 50. The last 2 days we had a bit of a correction, but this is kind of ×7 or ×6. So there's an enormous increase. I think, referring back to Geordie, who talked about this kind of super cycle, I think it's a bit of a indication that also, say, in the energy commodities, this is kind of taking place. And especially this rise of EUA prices is probably kind of the effect of the two major drivers that we see in the market. One is reflation, clearly, a lot of money becoming available for stimulating the economy, and the decarbonization of the industry. And if you look at how this price move came about, it's not so much the supply and demand for emission allowances that change, but it's just the inflow of money. Hedge funds who think, well, decarbonization is there to stay. There's only one way this will develop, so hence prices will go up. And that's the main driver for the prices. And when it comes to the question, do you kind of see the super cycle, or is it a super cycle? What will happen in general with prices? Well, I kind of looked at up a little bit what it actually means, the super cycle. We had one in 2000, and typically you would call it like that if it's about a substantial period really trading above the long-term average. I think for the commodities that I'm trading, gas and power, coal, that's not yet the case. It's a lot higher than what it was 1.5 years ago. But the exception is really carbon certificates that are, well, like I said, rose with about 6 or 7 times over the last 1.5 years. And when it comes to kind of how does kind of this green power fit in, It's good to understand that clearly there's a lot of new renewable capacity coming online, windmill, solar, what have you, at the expense of coal-fired and gas-fired power generation. But the product is still the same. You trade power. It's only that next to it you have the so-called guarantees of origin, which if you are a consumer and you want to make sure that you're using green energy, you buy the power as well as the guarantees of origin, and that is a product that is very much in development and with very wild price swings, and that's a kind of that's what you need to keep in mind if you talk about green power. So it's a kind of an extension of what we have seen in the past, with a new product that still need to kind of find its kind of shape, and also a good pricing dynamics around supply and demand. So it's in its infant stages, I would say.
Good points. Yeah, the ETS, I was watching that, when it went up through 50, I guess a couple of weeks ago, and now we're trading back there. That's more a policy-driven market, if I'm not mistaken. So.
Yeah, the supply and demand, or the supply, is completely determined by governments, and demand is, of course, if you have an industry or a power station that kind of falls under the scheme, then for whatever you produce, you need to buy the required certificates. But you see also the open interest. There's a lot of players who are only there for kind of for speculating purposes, which in itself in a market is not bad, but it's that is the key driver why we have seen this enormous price increase.
Interesting. All of which is directed at accelerating the phase out of fossil fuels. Interesting. Louis, given your ag's perspective here, would you argue that fossil fuels are dead?
Mute. And yes, I mean, I think it's more a question of when than if it's 50 years, 100 years, 200 years, 300 years, I don't know. But I think what Frank just said points to this hybrid model, points to this transition. But I mean, if you look at the car manufacturers, all more or less positioning themselves, saying that the combustion engine is dead, these are bold claims. They have a lot of time to walk back these statements, and technology has a long way to go to make, cars more efficient and combustion engine more efficient. And we've seen this kind of in the European market, where diesel engines were polluters, and then they developed technologies for them to become cleaner. And then the gas engine, kind of also ran against this. And you have 3-cylinder engines, super efficient, etc., on city cars that are better, and going against some of public policies like the French heavily subsidized French diesel production engine companies and so forth. But I think ultimately this converges to and it's not very sexy saying this, but a reduction in consumption. I think there's no escaping the fact that these carbon credits, they will be finite, in the sense that we'll create more and more certificates. We can compensate more. Price mechanisms will enter into play, and find that the balance of price versus production, and kind of force innovation. But I think this global awareness is here to stay, and I think there's various dimensions that technology itself discovers. But that shouldn't inhibit technology. I'll use, and I'm no expert, although I'm a gearhead, petrol head, which are obsolete terms in themselves, talking about the car industry. If you look at EVs, I think the technology is fantastic. It's growing at an exponential rate. But then now people are asking other questions. Well, wait, how are the batteries made? How are the circuits made? How are the chips made? How do we source these precious metals? What's the sustainability balance? And what is sustainability? I think now it's multidimensional. Of course, it's carbon on a first level, tangible level, but it's social, it's human, it's economic. So I think these are considerations that we need to try to map out, and it's a constant process. It makes the formalization of this harder, because you're running behind innovation and technology, which is always ahead by definition. And also there's the fungibility. Again, the Brazilian reality is not the European, American, Asian reality. So I think there's going to be and I think the financial space has a lot of creativity and products to offer. I think green bonds, to some extent, will play a part. Carbon credits will play a part. How the carbon credits between systems and geographies can eventually one day, converse. I think these are exciting times, and I think the financial sector will be ever closer to the industry, because you're going to need to get used to this reality. And I think carbon trading won't be the privilege of funds or experts, and I think it's going to be ever more common. And I'm sure this is something we'll touch on later, but I think even individuals and kind of retail trading will start looking at these, because these are the things that you read about in the newspaper, and newspaper also maybe being obsolete, but in the news. How do you bridge the conversations with your investment strategy, with your values as a company, as an individual? I think the questions are many.
Very true. Some of which go right to your wheelhouse, Geordie. The metals, as well as what Louis was saying. There's larger and larger ESG issues that have to be addressed here. Maybe you could give us your insights sitting on the desk, as it were, running the research there at Sucden.
Sure. So, I mean, as you rightly say, metals sort of find themselves in a quite unique position here in terms of the transition to a greener economy. For an example, for a sort of a general combustion engine, you've got around 23 kilograms of copper, but for a pure battery electric vehicle, you've got around 83 kilograms of copper per vehicle, which is a significant increase in the demand when you look at the sort of the roadmap for where we're looking to get to in terms of electric vehicles in, say, 2040. And as you rightly say, the batteries and the sort of the extraction of all these materials is a key issue here. When you look at the production of nickel, for example, for a nickel manganese and cobalt battery cathode, one of the main processes to create this nickel is through a process called high pressured acid leaching. Now, that is less emission intensive, but it's incredibly wasteful. So for around 1 ton of nickel, you're creating around 1.4 to 1.6 tons of waste. And the question sort of is raised of, what do you do with this waste? Now, obviously, you need to create the tailings dams. Previously, there were discussions around deep sea disposal. Now, that's we've sort of seen a move away from that due to pressures from the environmental community, and rightly so. But also, there's in that ESG factor, you've got the workers' rights as well, and sort of what are the workers' conditions of some of these producers in Indonesia, and especially as you transition to solar power. You see some sort of worker rights issues in some key producing areas in China as well. And so these are all factors that need to be brought into play here, and we are seeing more smelting capacity look to use renewable energy. Now that is going to increase that cost curve, and in particular, what we've seen in aluminium so far this year is increased restrictions from China in specific producing regions, such as in Mongolia, which have been sort of increased their emission standards, and that has led to an increase in sort of demand for renewable energy material outside of China, and there is more capacity which is used hydroelectric, but being hydroelectric, that is not available to everyone. And as you see further downstream, with specifically maybe auto sectors, then companies that are looking to create net zero pledges, they are increasingly after more carbon, low carbon alternatives, and hydro does play a part there. But also there's some technology in aluminium, which is in the anode technology, which significantly reduces the carbon emissions of that production of aluminium. But as you rightly say, so for this transition, we do need metals and we do need materials. Aluminium is said to produce around 2% of global emissions, and that's largely due to the sort of bauxite, alumina, and then finally aluminium process. But to create these materials for the transition, it's incredibly carbon intensive. And when you factor in nickel, copper, and aluminium, you're probably looking at around 12 billion tons of carbon to produce those metals. And so you're completely right. Whilst we do need these materials, we have to ask those questions about the emissions of these and sort of the impact of potential biodiversity and ecosystems of these tailings and of this production. Now, whilst as we move into that transition, we are seeing more and more technologies come to light, and you will start to see more metals capacity be powered by renewable energy, which is a positive. But it does take time, and it will likely increase that cost curve. But what was touched on earlier as well is, with this transition to the green economy, you have more involvement by the funds, and you have more sort of hype around prices, and that can lead to some sort of overextensions in the prices as well. But yeah, on the whole, I mean, metals are sort of uniquely placed, and we do see a strong demand for metals such as copper and lithium and nickel. We are starting to see a move away from cobalt, given the social issues regarding some of the mining in Congo, as producers look to sort of a slightly different cathode ratios, and that's more nickel production. But you're completely right. In the ESG side of things, you really have to look at the detail of what is the impact of this production, and can we reduce that more.
And just as an aside, I would note that it seems like the courts are getting more involved as well, enforcing this. They're almost, without knowing it, enforcing an ESG agenda. Particularly in Brazil, the Vale tailing lines. They're all subject to inspection now, and some of them are actually now not usable until they're fortified, so the risk of another rupture does not occur. So this I think we're just now seeing how big an issue that's going to be, ESG.
Yeah, and you are seeing more pressure from stakeholders in business in sort of earnings calls and AGMs, and also in terms of the green bonds we mentioned earlier. The sort of the sustainably linked bonds are becoming increasingly popular as a way for some of these miners to show and sort of create a pathway for them to a more sustainable future. And as you rightly say, Vale, and we saw some sort of heritage sites in Australia, and whether it's the sort of worker rights in sort of Congo or sort of Indonesia, these are all there. Increasing that transparency is a key way, and I think Louis touched on it. The consumer is really starting to want to know about what it is they are consuming, and we're starting to sort of get more of an idea of that.
Yeah, you might
just as an anecdote, if I may, Bob. I think to your point about Valley here. I remember not so long ago. 1 or 2 years ago, I was at a Financial Times event in Rio, and the CFO of Valley was talking about what had happened and owning up from a company standpoint to the responsibility they had, and he made it very clear in his speech that was broadcast live, etc., that there was no financial limitation to Valley implementing safety measures to get back to business. And I remember that day the share plunged. And I remember getting, message, are you seeing this? You're there, etc. And it actually bounced back relatively quickly, because I think once you work around the logic, yes, of course it's a great cost, but the cost of life, the cost of image is infinitely greater. So I think the sustainability from an economical standpoint is a sound argument. I think no one can build an argument saying, no, we need to disregard this. I think these are short-term wins that some more careless players who have incentives to cash out before the end of the game may have. But from a societal standpoint, from a long-term investor share standpoint, I don't see any arguments that would not be in favor of investing human and financial resources to answering these questions. in the most, in the healthiest kind of ways. And again, I think definitely some countries and companies have more incentive than others to push this agenda. I don't want to upset the flow, but there's one question in our chat here that maybe if you'll allow me to comment on, because I think it fits in rather nicely here. I think someone asked, is there a pathway that leads to oil and natural gas being around longer than the market expects? Well, I don't know what the premise here, but I think the market expects, oil and natural gas to be around a long, long time. I mean, that's my personal opinion. And then if you look at oil and natural gas, I think, look at these companies, I think, beyond the marketing and communication standpoint of BP, beyond petroleum, I think it's true. I think they're petrochemical companies. It's in their interest to, stretch the lifeline, the lifespan of their products, of, carbon products, by creating more efficient and cleaner technology. I think they can help also other sectors of the industry to make cleaner plastics, to make cleaner materials. If anyone has the technology, the know-how, the scientists, and the plans to do so, it's them. So I'm, again, I don't, as an exchange, we don't give forecasts. We don't. So this is a personal opinion, but I'm not by any means concerned about the survival and growth and transformation of these companies. But as we know them, again, a bit like petroleum, I think they will no longer be. And the shape and form they take, I'm sure there's more enlightened people who have an opinion, but I think it's happening. I think but I don't think they're going to lose unless they stick to their current or historical model. I don't even know if it's their current model, but the historical model of pumping carbon into the air. I think this model has a deadline.
Maybe to add to that, Bob, if you allow me.
Yeah, of course.
I think it is also very much a question of technology that may come that we do not know of. I mean, if you compare it with natural gas in the US, where there was large volumes of unrecoverable gas, and then we had the shale technology, and then all of a sudden there was an abundance of gas just because of a technology breakthrough. And if the oil majors or anybody else would invent a technology to kind of divide the carbon out of the gases once you burn it, and I mean, you have carbon CSS technology, but if you would have a technology breakthrough that does something useful with the carbon, that kind of would cast a completely different light on oil and gas.
We just did some research along those very lines, that CCUS technology. You can strip out the carbon from the natural gas and produce the blue hydrogen. The only thing that you would need would be possibly some support either through the tax system or through subsidies, to get that technology up and running. And a way to use the carbon that you take out, or the CO2, which you can use. I mean, you can use it for enhanced oil recovery. So you can have that closed loop. You pull the carbon out, you pull the CO2 out, re-inject it into the reservoir, pull nat gas out, and then strip out the hydrogen. And it's blue, it's not green. Green is still going to organically produced hydrogen is still going to be more expensive, but it's conceivable it could get there. And Louis, as you make the point, these guys have a lot of money and a lot of engineers looking for something to do. So, your view on the hydrogen, though, Frank, I was interested in that. Do you think that becomes a traded commodity?
Yeah, a lot of people talk about it, and I attended a kind of conference type of thing earlier this week where already people were talking about an index for hydrogen, for green hydrogen. But the case at the moment is that there's no green hydrogen, so hydrogen produced from green electricity that I know of in any kind of significant volume. So we're still at the very beginning. But if you see how many companies are planning or committing to projects to produce green hydrogen, and the support from governments and politicians, that's really enormous. So we will have these plants built, both in Europe and I guess also in Africa, to ship the hydrogen or some other substance energy carrier to Europe. So it will come, but first we need kind of supply and demand to have some kind of spot market to speak about any kind of hydrogen market for green hydrogen. There's one thing that you could think of that may fast track that, and that is the fact that if you produce hydrogen, you can also inject it in the gas grid up to a certain percentage, for which you would then get guarantees of, well, I don't know if they're called guarantees of origin, but kind of certificates for hydrogen, which they can then be bought by consumers who can kind of claim that they bought hydrogen rather than natural gas, and that could kickstart that. But yeah, to answer your question, it will come, but it will take certainly a few years.
Yeah, before we get off that topic, you know, I was wondering also if Geordie had any thoughts on what the risks are to the renewables and the EV build out that we're all talking about and expecting, and how it meshes up with the you know, the hydrocarbons.
Sure. I mean, I think one of the main risks which we have touched on is the ESG surrounding the extraction of some of these minor and rare metals. Now, I think some of these critical minerals, I mean, are in low supply and they're hard to get to. And I think one of the things that the Green New Deal is really pushing, and I think we'll see more and more of, is the circular economy and recycling of metals. You have the European Battery Directive, which is looking to increase the material of recycled content in batteries, has two deadlines, 2030 and 2035. And I think we're going to have to see a greater adoption of that circular economy and recycling to really help the market achieve some of these targets for the electric vehicle rollout. And I think that's one thing that we're just looking at, and we've been speaking about sort of fossil fuels, and can the raw materials for the batteries be supplied at a fast enough rate for demand? You're going to obviously have to have a certain level of primary material to enter the market before you can start recycling, and the time lag for obviously starting mines and getting the financing is quite a long time. So really, it's surrounding that resource extraction stage, and also the social side, and the worker rights, and how what cost is this they're gonna come at for the producer and the consumer. Shifting smelter capacity away from coal powered to renewable is expensive, and as we've seen in aluminium this year, as the market perceives capacity to be shifted, one of the largest producing countries of a metal, price is going to rally as that capacity is taken offline and transferred into renewable energy. So really, it's those factors that are really sort of the threat to this rollout, from my perspective.
And I think complementing kind of what Geordie says, you know, talking about trying to bring this to the context of, you know, the COVID global sanitary crisis, and how this has changed behaviors. You know, if you looked at the beginning of 2020 and you looked at the car industry, it was pretty bearish, right? Yeah. But now you have people who, you know, are, you know, walking, staying far from public transport, who are also leaving the city. It's kind of renewed the interest in cars, and then you cross this with the price of metals, the price of batteries, etc. I mean, and the inflation in Brazil on a local level, and you look at the price of cars, and it's shocking, the increase, right? And I think these are the factors, macroeconomic, social, that we don't know, that will also cross our path to the future, and that will upset, you know, whatever kind of discussions and theories and ideas, and will change the implementation down the road.
Do you foresee greater? Let me step back for a second. Putting a price on carbon would, you know, put a lot of the economics of the technologies we're talking about on a different footing. do you see that as developing globally? I mean, do you see like exchanges like yours, linking up with others like the ETS system, in Europe? China's trying to, get its own ETS system going. Is this the goal or the role, or, I mean, it strikes me just from a purely economic point of view that, the way you incentivize investment to a desired outcome is to make the undesired outcome way more expensive. So carbon taxes might be preferable as well.
Yeah, I think, this. I'll speak more to the Brazilian side of the discussion that I'm more familiar with. But I think the theory is the one you described. There's more or less a consensus as this one on this one, that we need global fungibility. We need to be able to cross trade. The financial incentives needs to deter negative externalities, etc. But I think here, we need to kind of learn to walk before we learn to run, and bicycle before we drive, and etc. etc. And if you look at the way Brazil is acting on this, I think it's at the early stages of the discussion. We launched last year the CBIO product, which is a carbon credit that was specifically designed in reaction to a law for the renewable fuels in Brazil, and for fuel distributors to buy these credits from biofuels producers. And I think here, and it's an OTC product. And maybe one day it'll go on screen, but I think you need to create a market, and this market, it needs to trade first. I think the first step is satisfying the regulatory obligations, and that's not trading, that's an obligation. So it's a requirement, you need to do it, I think. And so you'll have a buyer and a seller, and then it'll stop there. I think what you want to see for this to be successful is to start trading. And again, then you go into other considerations such as price structure, cost structure, and then, in developing countries such as Brazil, where inflation is a huge problem, and the governments have a big attention on tax. They see these incentives as also a source of inflation, which also something they're trying to control. So it makes for a slower start. But I think ultimately, again, we need to show the carrot, and people will find solutions. And I really do think that companies and exchanges and regional exchanges will be able to provide this service, create a local market. And I think once you have a local market, you can start integrating the global market. But what I don't see happening is, trying to exploit, and I don't mean this as a negative thing, but countries that have an apparent excess of carbon, and kind of export those credits abroad, because I think that would just tip the scales, and that would be just creating paper carbon, which is already happening. Like, if you look at the footprint of the world, you have countries with larger forests than others, and sure, they should be able to benefit from this, and it should be an incentives for them to preserve their forests, etc. But there needs to be, I think, a balanced approach to how these credits will converse in between themselves.
So just sticking with the regulation and all that, Frank, we're all following it very closely. I follow something I really didn't think I would be doing, following the ETS, for policy guidance. But what's the impact of the regulation on the European energy trading markets?
Well, at first it was a burden or an effort for companies like Vattenfall, so utilities, to put all this in place. So it was certainly at a cost. But at the same time, I think it was also needed. When I started as a gas trader more than 20 years ago, everybody traded like crazy, the 10 minutes before 5 to kind of mark the close and push the index in the direction you wanted. And that kind of behavior, through the kind of regulation and the the obligation to report transactions, but also to report events through UMMs, I think that has disciplined the market quite a bit. So I think that is good. At the same time, there's also a tipping point. If we would get more regulation, especially for companies like or utilities who are in the core not a trading company, that it would kind of hurt the the trading activities, because then the burden for all kind of regulatory process becomes too big. But I think up to now, I think the net result is certainly positive.
That's excellent. I think we've covered a lot of ground. Is there anything that I missed or should have asked, before we close this out?
Maybe there's one question in the chat about CO2 pricing. What's the role of it, and what's the effect? To what extent does it affect the price of other commodities?
Yes.
We already kind of touched upon it, but in Europe, where I think the most mature market is existing, it was kind of introduced as a way to to move people away from carbon-intensive activities to less carbon intensive activities, and of course it has played its role. But at the same time, I think the majority of the decisions to move out of coal-fired generation across Europe were done at when EUAs were trading below 20, at a level where it would still kind of be profitable, but there were kind of a lot of other factors kind of influencing that decision, which from a society point of view, of course, made clearly sense. And now, where we have levels of above 50, then it's clearly affecting the prices of commodities, but also all kind of other products. If you have a business which is very much relying on power prices, and with that on carbon prices, this now becomes an issue with 50 euro prices. So I think in itself it is an interesting experiment, and it's probably the best you could think of to move towards as you put it, Bob, putting the cost of the undesired outcome. It's a bit difficult to kind of steer, because at the end of the day, the supply is determined by the government, and it's a supply of something that doesn't exist. So you make up a number, and that's a supply, and maybe too high or too low. And if the market becomes a subject of a lot of speculation and the kind of the price rise which we've seen recently, then it starts to affect all kind of other prices.
Yeah, good point. All right, Philip, I think we've covered the waterfront here. Thank you all for participating and sharing your insight. It was an excellent discussion. Thank you very much.
Perfect. Thank you very much, Bob and panelists. That is the end of the FAW European Derivatives Conference 2021. I'd like to thank all of our speakers and delegates for participating. We really hope you have enjoyed it as much as we have. I'd like to thank our sponsors, Euronext, B3, SIBO, ABN AMRO Clearing, BME, JPX, Singapore Exchange, TMX Group and Vienna Stock Exchange. Thank you also to our media partners, Crypto Academy, European Venues and Intermediaries Association, and FinTech Ireland. I'd also like to thank the FOW team for putting on such a great event. We hope to see you all soon. Thank you and goodbye.